All right, buckle up, tech fans. We're diving into a story that's got Wall Street buzzing and Main Street scratching their heads. Ryan Cohen, the meme stock maestro, the guy who turned GameStop into a rocket ship, has reportedly dropped a cool $1 billion on Chinese tech giant Alibaba. I know, right? It sounds like the start of a movie. But is this a stroke of genius or a high-stakes gamble that could backfire big time? That's what we're going to unpack today. Get ready for a wild ride. Let's get straight to the facts. According to reports from the Wall Street Journal and others, Ryan Cohen, the CEO of GameStop and founder of Chewy, has quietly amassed a significant stake in Alibaba, estimated to be around 7 million shares, worth about $1 billion. This isn't exactly pocket change. Apparently, Cohen has been in private discussions with Alibaba, pushing them to repurchase their shares more aggressively. He believes, and many others agree, that Alibaba's stock is currently undervalued. This news sent Alibaba's stock soaring, with shares jumping as much as 8% after the announcement. So what's the big deal? Why is everyone so interested in this move? To understand this, we need to look at Ryan Cohen's track record. This guy isn't your typical Wall Street investor. He made his name by building Chewy into a pet supply powerhouse, and then he became a folk hero by leading the charge on GameStop during the meme stock frenzy. He's known for identifying undervalued companies, taking a significant stake, and then pushing for changes to unlock their potential. Remember Bed Bath & Beyond? He bought a big chunk of that, pushed for changes, and then sold for a hefty profit, though that story ended badly for a lot of other people. So, Cohen's strategy is clear. Find value, agitate for change, and profit. But Alibaba is a different beast altogether. This isn't a struggling brick-and-mortar retailer. It's a global tech giant operating in a complex and often unpredictable market. Now, let's talk about Alibaba itself. The company has been facing headwinds in recent years, including increased regulatory scrutiny from the Chinese government and intense competition from other e-commerce players like JD.com and Pinduoduo. However, Alibaba remains a dominant force in the Chinese market, with a massive user base and a diversified portfolio of businesses, including e-commerce, cloud computing, and digital payments. Its recent earnings report showed a strong rebound, particularly in its cloud intelligence unit and e-commerce segment. The company is also investing heavily in new technologies like artificial intelligence, which could drive future growth. So, Cohen's bet on Alibaba is essentially a bet on the long-term growth of the Chinese economy and Alibaba's ability to navigate the challenges and capitalize on the opportunities in that market. Cohen's argument, and one supported by many analysts, is that Alibaba's stock is significantly undervalued. The company's share price is still well below its peak in 2020, despite the strong growth in its underlying businesses. This undervaluation is due to a number of factors, including concerns about regulatory risks, geopolitical tensions, and slowing economic growth in China. However, Cohen believes that these concerns are overblown and that Alibaba's long-term prospects remain bright. He's pushing for Alibaba to buy back more of its own shares, which would reduce the number of shares outstanding and boost the stock price. This is a classic value investing strategy, and it's one that Cohen has used successfully in the past. Okay, so what are the potential downsides? First and foremost, there's the regulatory risk. The Chinese government has been cracking down on tech companies in recent years, and there's no guarantee that this trend won't continue. Alibaba could face further regulatory scrutiny, which could negatively impact its business. Second, there's the geopolitical risk. Tensions between the US and China remain high, and any escalation could disrupt Alibaba's operations and its access to global markets. Third, there's the competition. Alibaba faces intense competition from other e-commerce players, both domestic and international. And finally, there's always the risk that Cohen's strategy won't work. He could push for changes that Alibaba management resists, or the company's stock price could simply fail to rise. So, this is not a risk-free investment by any means. Now, let's look at the differing viewpoints here. On one side, you have the optimists who believe that Cohen's involvement is a positive sign for Alibaba. They argue that he's a savvy investor who knows how to unlock value, and that his presence will force Alibaba to become more shareholder-friendly. They point to the fact that Alibaba's stock price jumped after the news broke as evidence that the market approves of Cohen's investment. On the other side, you have the skeptics who believe that Cohen is simply trying to pump up the stock price for a quick profit. They argue that Alibaba is facing too many challenges to overcome and that Cohen's efforts are ultimately doomed to fail. They point to his past involvement with Bed Bath & Beyond as an example of how his strategies can backfire. So who's right? Well, that's the million-dollar question. There's another layer to this story that we haven't touched on yet, the Chinese government. Alibaba's outspoken founder, Jack Ma, has largely kept out of the public eye since 2020 after criticizing Chinese regulators. Recently, he attended a rare meeting with President Xi Jinping, who urged private businesses to show their talents and strengthen their confidence. This could be interpreted as a sign that the government is easing its pressure on tech companies, which would be good news for Alibaba. However, it's also possible that the government will continue to exert control over the tech sector, which could limit Alibaba's growth potential. Cohen's investment could put him at odds with Xi Jinping's crackdown on tech giants, as Fortune magazine suggests. So, the political landscape in China is a key factor to watch in this story. Let's not forget the AI angle. Chinese tech companies like Tencent and Baidu are aggressively integrating AI into their products, and Alibaba is no exception. They're leveraging AI to improve their search engines, personalize recommendations, and automate various business processes. This is crucial for staying competitive in the rapidly evolving tech landscape. DeepSeek AI, in particular, has gained significant traction, with companies like Tencent and Baidu integrating its models. The pace at which Chinese companies are adopting AI reflects the intense competition and the desire to establish themselves as AI leaders. Alibaba's success in this area will be critical to its long-term growth and profitability. So what's the takeaway here? Ryan Cohen's $1 billion bet on Alibaba is a high-stakes gamble that could pay off big time, or it could end in disaster. He's betting that Alibaba is undervalued and that he can unlock its potential by pushing for changes. But he's also facing significant risks, including regulatory uncertainty, geopolitical tensions, and intense competition. The outcome will depend on a number of factors, including Alibaba's ability to execute its strategy, the Chinese government's policies towards the tech sector, and the overall health of the global economy. This is a story that's worth watching closely because it could have major implications for the future of Alibaba, the Chinese tech industry, and the global economy. What do you think? Is Ryan Cohen a genius, or is he playing with fire? Let me know in the comments below. And don't forget to subscribe for more in-depth analysis of the tech world.